Welcome to the half-year results presentation for NWF. This is for the period ending 30th of November 2018. It's been a positive first half with all three divisions performing as planned, and the board's full-year expectations remain unchanged. Profits are up, net debt is down, and we've delivered a fuels acquisition in line with the growth strategy of the group. And in terms of the group overview, revenue is up 12% to 330.5 million. And most of the revenue increase was as a result of higher commodity prices in the period. The key number for us, as always, is the headline profit before tax, and that was up a positive 9.1% to 2.4 million. Net debt was lower at 14.8 million, and critically that only represents 1 times EBITDA, which is the level at which the board is comfortable. And as is our normal policy at this time of year, we've maintained the interim dividend at £0.01. Now turning to the divisional highlights, and I'll start with fuels. It's been a good start to the year, trading in line with our expectations. We had a warm summer, which reduced demand for heating and gas oil, but then very much a normal autumn condition. So you can see operating profit at 0.9 million, in line with our expectation. We've also taken a look at our tanker fleet, and here we've determined that 5 years is the optimum age to change a tanker. So we're refreshing the fleet this year and actually building 49 new tankers which will be joining the fleet, and this will reduce cost and improve availability and customer service. We've successfully transitioned to our new managing director, so Richard Huxley's now been in charge of the business for 8 months and performing well. And also we're pleased that we've acquired Midland Fuel Oil Supplies. This is a 12 millilitre fuel business in Solihull which supplies customers to the south and east of Birmingham, and it's been successfully integrated into our Kenilworth depot. So in summary, volume down 2%. That's as a consequence of the warmer summer, but operating profit 0.9, in line with what we'd expect at this time of the year. If we then turn to our food division, significant profit improvement compared to the second half last year, which is as we expected, and profits at £1 million in the first half. If you remember last year, we had a large number of new customers joining the business. So in all, we had 20,000 pallet spaces of new business. And we're pleased to report those are bedded in and are performing well. Storage levels are up, as you can see, 8% to 96,000 pallets. That means we're very full. But even more critically, activity levels are up 13%. So that means about another 20 loads every day. So that's 20 loads coming onto our site and off our site every day, which meant we're very busy. So that's positive, but there are opportunities to improve our efficiency further as we go forward. In the period, we also completed a successful trial with Aldi. This was a 15-week trial, and we're now an accredited supplier to their distribution centres across the country. Our e-commerce business continues to grow. We've now got 4 customers working in this facility and about another 7 that are lined up to join us in the next 12 months. In terms of our stock holding, we do have about 5,000 pallets of what I call Brexit protection stock. This is where we're supporting our customers' stock holding requirements. And in our feeds division, a strong performance in the first half. Operating profits up to 0.7 million, and very much we had a half of 2 quarters. In the summer, we had a long dry period, and what that meant was grazing conditions were poor. So our nutritionists up and down the country advised higher feed rates, and those were implemented and maintained milk output for our farming customers. In the autumn, we then had better conditions for grass growth, so there was a longer period of grazing, and actually farmers' stock of forage recovered to more normal levels. Price increases have been passed through along with higher commodity prices, and actually the milk market itself in the first half was fairly positive, with milk prices up over 4p in the period. That's come back a little bit since then. And milk production was flat at an annual rate of just over 12 billion litres. So in terms of our business, you can see profits up, volumes up 5%, that's broadly in line with the market, and revenue up as a result of volume and those higher commodity prices.
Hi, I'm Chris Belsham, the Group Finance Director, and I'm going to take you through the financial highlights of our first half, starting with the income statement. Revenue increased by 11.7% in the period, partly due to increased activity in food and feeds, but mainly due to an increase in commodity prices, with the average oil price across the period being 38% higher than prior year, and our average cost of raw materials in feeds being 9.9% higher. Our operating profit was up by 8.3%, with fuels a little behind the prior year due to the lower demand across the summer, but with strong margin management, meaning the business is well placed going into the winter. Food was ahead by 0.1 million and feeds by 0.3 million. We do have an exceptional item in the period, which is due to some technical changes in respect of the pension scheme. It's a non-operational matter and non-recurring. As Richard's mentioned, we will be paying a dividend of 1 penny at the start of May. Moving on to our balance sheet, our net assets increased by 7.3 million in the period. This was helped by a reduction in the pension deficit and a reduction in net debt. Plus, we invested 3.2 million in increased working capital due to increased commodity prices. As a result of the higher net assets, our group return on capital employed has fallen a little bit to 13.8%, and that is still well ahead of our weighted average cost of capital. Our pension deficit reduced by 1.7 million in the period. That's largely due to an increase in the discount rate by 0.5%, countered somewhat by an increase in inflation of 0.25%. We continue to make contributions of 1.8 million per annum. At this level, it does not constrain any investment in the development of the group. On a rolling 12-month basis, we expect to generate 2 to 3 million of cash before development expenditure. You can see from the bridge that over the last 12 months, we've generated 2.3 million over that period, with the outperformance in fuels in the latter half of the last financial year, partly offset by the increase in working capital in the first half. Whilst our net debt is low, it's important to have facilities available for development, and we continue to have up to 65 million of facilities available through RBS until October 2023. The majority of this facility is a 50 million invoice discounting line. Those facilities are available at attractive interest rates with market standard covenants. So overall, a good set of results in the first half, with the business well placed to continue its development into the second half.
If we now start to look at the strategy of the group going forward, I'll start with the fuels division. As you can see on the map, there are 19 depots positioned on there, with the addition now of a 20th depot, which is Midland Fuel Oil Supplies, which is integrated into our Kenilworth depot. There are 150 players smaller than us in this market, so there's a significant opportunity for further consolidation. That's both to integrate businesses into our existing depots or also to expand our geographic reach around the country. And there are opportunities in this space which we continue to work on. The acquisition of Midland Fuel Oils in December is a good example of an excellent bolt-on which can complement our existing business. Now, if we look at the development strategy for food, it's all about optimising the customer mix and targeted expansion. We're working with 200 customers, and these are blue chip manufacturers of food or importers. We've got contracts with these customers, and the key is to expand as they want to expand and look for added value services. The opportunities that we present in e-fulfillment and with our pallet line distribution network are examples of where we can add further value to our customers' business. And we continue to look for targeted expansion. And in the feeds division, we're looking at operating efficiency, consolidation of the market, and broadening the target offering. If you look at the map on the right-hand side of the picture, you can see the location of our 4,000 farming customers. And these are ruminant farmers, and therefore they live down the west coast of the UK where the rain falls and the grass grows. We've got our facilities in the north, Midlands and south which are perfectly aligned to meet our customers' needs. And there's a very big opportunity in terms of what I call operating efficiency. In this market there are 18 other principal players, and we have highlighted previously consolidation of this market is an opportunity. But it's crucial that we find willing sellers to further develop this space. And in addition, we're looking to broaden the offer that we supply to our 4,000 farmers. There are a number of nutritional products and actually products in the animal health space that we're now introducing into the market that can broaden our offer further. So finally, in terms of a summary and outlook, we're pleased with the profit improvement that we generated in the first half. The board's full year estimates remain unchanged. And in terms of each of the divisions, on fuels, it's about effective management of volatile oil prices, which we've seen recently, and also more normal winter conditions. In food, it's about managing the higher storage rates that we've got and improving the efficiency of our operations. And in feeds, it's continuing to benefit on the prior year's investment. We've demonstrated strategic delivery with the fuels acquisition in December, and we have a strong balance sheet to support the group going forward. And so this all means we're confident in the future development opportunities for the group and the outlook for the current year. Thank you very much.